Hey everyone, and welcome back to Book Summary Podcast. Today we're going to be taking a deep dive into a world that might seem a little intimidating at first glance, the world of high finance and risk management.
Oh, yeah, it can definitely seem that way.
But don't worry, we're going to make this journey fascinating and, believe it or not, surprisingly understandable.
That's right.
We're cracking open Risk Management and Financial Institutions by John C. Hall.
It's a great book.
And this book is it's a bit of a beast, let me tell you.
It's a long one.
But don't worry, we're going to break it down.
yeah.
But within its pages, there's this treasure trove of knowledge that can really empower you, whether you're a seasoned investor or just starting to explore the financial world.
Absolutely.
And if you're enjoying this deep dive so far, don't forget to hit that like button and subscribe to our channel for more insightful book summaries.
Yeah, hit that like button.
All right, so what's remarkable about Hull's approach is how he manages to demystify these really complex concepts and make them relevant to everyday investors like you and me.
Yeah, he's really good at that. And he doesn't just throw equations around, he actually tells stories.
Oh yeah, I love that.
He weaves together theory and real-world examples, stuff that sticks with you.
Absolutely. And one of the most fundamental concepts he tackles right off the bat is this inherent relationship between risk and return. It's the cornerstone of any investment decision.
Oh, it's huge. Yeah, for sure.
We all want those high returns, but are we really grasping the risks that come with them?
That's the big question, isn't it? And that's where Hull's distinction between actual return and expected return becomes so important. Actual return is what you actually end up with.
The cold hard cash.
Yeah, exactly. The cash in hand.
Yeah.
But expected return is a little more nuanced. It takes into account the probabilities of different outcomes. So, it's not a guarantee. It's more like what you should expect on average over time.
Okay, so let's break this down with a concrete example.
Sure.
Hull uses this scenario of investing $100,000 in a stock.
Right.
What stood out to you about that example?
Well, he presents this probability table almost like you're, playing a game of chance. There's like a 5% chance of a 50% return.
Oh, wow.
But then there's also a 5% chance of a 30% loss.
Oh.
And then there's all sorts of possibilities in between,
Right.
each with their own probability. So the expected return isn't just the average of all these potential returns, it's a weighted average.
So you're multiplying each return by how likely it is to actually happen.
Exactly.
Okay.
You got it.
So it's not just about focusing on the potential upside. It's about really understanding the full range of possibilities, good and bad.
Absolutely. And this leads perfectly into the next big concept, diversification. Hull argues that by spreading your investments across different asset classes, you can actually improve your overall risk-return balance.
It's like that old saying, don't put all your eggs in one basket.
Exactly. And he doesn't just stop there.
Yeah.
He uses this simple example of combining two investments
Okay.
and shows how their combined risk-return profile can be totally different from what they would be on their own.
And that's where figure 1.2 really helps you visualize that.
Oh, it's a great visual.
It shows how different weightings between the two investments create this whole curve of potential risk-return combos.
It's like a menu of choices. You can tailor your portfolio to your own personal risk tolerance. Want to take on more risk for more potential return? You can do that. Or, if you prefer a more conservative approach, you can do that too.
Now, to help investors navigate this whole risk-return landscape, Hull introduces this model that's kind of become a cornerstone of finance, the capital asset pricing model.
Right, or AAPM.
Yeah, CAPM. Now, I know the name sounds a little intimidating,
It does, doesn't it?
but it's not as scary as it sounds.
Oh, no, not at all. It's actually pretty interesting.
So what's really interesting about CAPM is that it tries to quantify this relationship between risk and expected return, specifically looking at systematic risk, which is the risk that's inherent to the whole market, the kind you can't eliminate just by diversifying.
Right. It's the risk that's always there no matter what you do.
So APM is trying to figure out how much return you should expect for taking on a certain level of systematic risk. And to measure that risk, we use this metric called beta, represented by the Greek letter BK.
Beta basically tells you how much an asset's price is likely to move compared to the overall market.
Okay?
So a beta of 1 means it moves kind of in sync with the market. A beta greater than 1 means it's more volatile. And a beta less than 1 means it's less volatile.
Okay, so imagine I'm looking at a stock with a beta of 1.5.
Okay.
That means if the market goes up 10%, this stock is likely to jump up 15%, but it could also plummet 15% if the market takes a nosedive.
Yeah, that's a good way to think about it. And the cool thing about CAPM is that it gives investors a framework for making more informed decisions.
It helps you understand if the potential return is worth the risk you're taking on. It's like having this roadmap that can guide you through all the complexities of choosing investments. But as with any model, it's important to remember that CAPM is a simplification. And there are other models out there that offer different perspectives.
Oh, for sure. Hull briefly talks about arbitrage pricing theory,
Okay.
which, unlike CAPM, considers multiple factors that can drive returns, not just the overall market movement.
So it's adding more nuance to how we understand risk and return.
Exactly.
Now, so far, we've been looking at risk from the perspective of, individual investors like us.
Right.
But what about these huge financial institutions? The ones handling trillions of dollars.
Oh, yeah, that's a whole other ballgame.
Yeah.
And that's where the book gets really interesting, because Hull points out that these financial institutions, they're not just concerned with maximizing returns for individual clients. They're responsible for safeguarding the stability of the entire financial system.
And that's where all the regulation comes in.
Oh, yeah, the regulations are a big part of it.
Governments all over the world, they put these strict rules in place to prevent these institutions from taking on too much risk.
Right, because if one of these big institutions goes down, it could take the whole system with it.
And unlike individual investors, who might mainly focus on systematic risk,
Right.
financial institutions have to grapple with total risk.
Which includes both systematic and unsystematic risk.
So they're not just worried about market crashes.
Oh, no, they have to worry about all sorts of things.
Right.
Operational failures, fraud, you name it, even natural disasters.
Oh, wow. To understand how all these regulations came to be, Hall actually takes us through the history of the U.S. banking system. It's a really fascinating overview.
Oh, it is. It really shows how things have evolved over time.
Yeah. One thing that stood out to me was that table on bank concentration in the book. It shows this dramatic shift in the distribution of assets among U.S. banks from 1984 to 2014.
Yeah, it's a crazy difference.
Really shows you how much the financial landscape is constantly changing, shaped by things like deregulation, globalization, all these different forces.
Technology, too. You can't forget about technology. It's had a huge impact.
Absolutely. And all these changes have big implications for how risk is managed.
For both institutions and individual investors.
Now, speaking of regulations, the book digs into two really key pieces of legislation that have reshaped the whole financial industry: the Dodd-Frank Act and the Volcker Rule.
Oh, yeah. Those were game changers.
Both came about after the 2008 financial crisis.
Right. It was a direct response to what happened.
Now, these names might sound like dry legal jargon, but they have real-world consequences for all of us.
Oh, absolutely.
So the Dodd-Frank Act was enacted in 2010. It aimed to strengthen regulations, prevent another crisis, by making things more transparent, enhancing consumer protection, and putting stricter oversight on those institutions.
Right, trying to make sure it doesn't happen again.
And then the Volcker Rule, that's a key part of Dodd-Frank.
Yeah.
It specifically targets something called proprietary trading.
Which is essentially banks using their own money to make risky bets in the market.
Yeah, basically gambling with depositors' money.
Yeah, not good.
No.
So the Volcker Rule tries to curb that excessive risk-taking.
I love how Hull connects these regulations to the actual events that led to their creation.
Oh, yeah, he's really good at that.
Showing that these aren't just abstract concepts. They're meant to prevent real harm.
Absolutely. It
Yeah.
makes it all much more real and understandable.
All right, now shifting gears a little bit,
Okay.
let's talk about IPOs.
Initial public offerings. It's when a company goes public and offers its shares to the public for the first time.
That's a big moment for a company.
Oh, yeah. Huge. They're basically transitioning from a private entity to one that's owned by a much wider range of investors.
But Hull introduces this really interesting alternative to the traditional IPO, the Dutch auction.
Oh, yeah, the Dutch auction. It's very different from the typical IPO. Instead of investment banks setting the initial price, in a Dutch auction, investors get to bid on the price they're willing to pay.
It's kind of like a reverse auction.
Exactly. The price starts high and gradually goes down until there are enough bids to sell all the shares.
And the cool thing about this approach is it's designed to find a more accurate market price, cutting down on that potential for underpricing that often benefits, those favored clients in traditional IPOs.
Right. It's supposed to be fairer and more transparent.
Exactly.
And Hull gives us a great example of a successful Dutch auction. Google's IPO back in 2004.
Oh, yeah, that was a big one.
Oh, yeah. It shows how a company can actually use this method to get a more fair price for their shares.
Okay, now let's move on to something that's close to all of our hearts. Insurance.
Yeah.
It's all about managing risk, right?
Absolutely. Protecting ourselves from the unexpected.
And Hull covers all sorts of different types of life insurance.
Mm.
Term life, whole life, endowment policies.
Yeah, he goes through it all.
And he explains how they can be tailored to different financial goals. What I found interesting was his example of the UK annuity contracts,
Oh, yeah.
where insurance companies guaranteed minimum interest
It
rates.
sounds like a safe bet, right?
Right, like a guaranteed return.
Right.
But he shows how even those guarantees can backfire when something unexpected happens.
Like declining interest rate.
Right, exactly.
Yeah.
And that's what happened. It caused major problems for those companies.
Yeah, those guaranteed rates suddenly became a huge burden. It really shows you how challenging it can be to manage long-term risks in a world that's constantly changing.
Yeah, it's a cautionary tale.
Definitely.
Even those financial products that seem super secure, they can be vulnerable.
Yeah, you always have to understand the underlying risks, no
Yeah.
matter what.
Now, I've always wondered how insurance companies figure out those premiums.
Oh, yeah, the monthly payments.
Yeah. It seems like a mystery.
A bit of a black box.
Yeah. But Hull actually breaks it down, taking us into the world of actuarial science.
Yeah. He does, and it's actually fascinating once you understand how it works.
It really is.
Yeah.
He walks us through this example of calculating the break-even premium for a 90-year-old man looking for term life insurance.
Okay.
It sounds a little morbid, but it's a great way to show the analytical side of insurance pricing.
Oh, yeah. It really highlights how actuaries use these statistical models and mortality tables to figure out the right price for different coverages.
They're taking into account all these factors like age and health and lifestyle, even your occupation.
It's complicated stuff.
It is. So after exploring life insurance, Hall then compares it to the world of property and casualty insurance.
Right. Things like car accidents and house fires.
Yeah.
Much more unpredictable.
So what's the big difference there?
Well, life insurance deals with mortality, which is actually pretty predictable over large populations.
Okay.
Property and casualty insurance, that's dealing with events that are much more random.
Things that could be catastrophic.
Yeah, exactly. And that's why property and casualty insurers need to hold a lot more equity. They have to have a bigger cushion to absorb those unexpected losses.
Okay, now let's talk about mutual funds.
Those investment vehicles that pool money from multiple investors.
Right, to purchase a diverse portfolio.
They've become super popular. It's a way for individuals to get access to those professionally managed portfolios without having to pick stocks and bonds themselves.
Makes it a lot easier.
Oh, yeah, for sure.
But there's one aspect that people often overlook. Fees.
Oh.
It's easy to ignore those little percentages.
Well, yeah, they seem so small.
But Hull makes it clear that over time, those fees can really eat into your returns.
It's like a silent drain on your investments.
Yeah, and the book shares some findings from a study by Carana, Surveys, and Tufano.
Okay.
They compared fees across 18 different countries. And it's crazy how much they vary.
Oh, yeah. The average fee in Australia was only 1.41%.
That's pretty low.
But in Canada, it was a whopping 3%.
Oh, wow, that's a huge difference.
Yeah, and over the long term, that can add up to thousands of dollars in lost returns. It's crazy.
It is. So it's a good reminder to pay attention to those expense ratios before you invest in a mutual fund. Don't let those fees chip away at your hard-earned money.
Absolutely.
Now, unfortunately, the world of mutual funds hasn't always been perfect.
Hmm.
Hull takes us back to the early 2000s and this scandal that rocked the industry.
Oh, yeah, the late trading scandal.
What happened there?
Well, basically, some brokers were allowing favored clients to buy or sell shares after the 4 p.m. deadline.
So they're getting an unfair advantage.
Yeah, basically, they were profiting from market movements after the market had closed.
So it's a reminder that even in a highly regulated industry, there are going to be ethical breaches.
Yeah.
Investors have to be careful.
Oh, yeah, you always have to be vigilant.
The late trading scandal, though, that led to some major reforms and increased scrutiny.
Oh, yeah, for sure.
It shows how important transparency and ethical conduct are for maintaining investor trust. Now, on a more positive note, Hull introduces us to a popular alternative to those traditional mutual funds. Exchange-traded funds.
Or ETFs.
Yeah, ETFs. So what are the big advantages of ETFs?
Well, unlike mutual funds, which are only priced once at the end of the trading day,
Right.
ETFs can be traded all day long, just like individual stocks.
Oh, wow.
So you get a lot more flexibility to react to market movements.
And capitalize on opportunities.
Exactly. And ETFs also typically have lower fees than mutual funds, which is great for those cost-conscious investors.
Right, good thing.
Plus, they tend to trade at prices that are closer to their net asset value, so there's less chance of a discrepancy between the market price and the actual value of the fund's holdings.
So they're more transparent.
Exactly.
Okay, now let's dive into the world of derivatives.
Oh, yeah, derivatives. Those financial instruments that get their value from an underlying asset.
They sound complicated.
They can be, but at their core, they're just contracts that let investors speculate on future price movements of things like stocks, bonds, currencies, even commodities.
Okay, so Hall starts off this exploration with forward contracts.
Right. Those are agreements to buy or sell an asset at a future date at a set price.
So you're locking in a price today.
Exactly. For a transaction that will happen later. Imagine a company that needs to buy a large amount of a commodity like oil or wheat 6 months from now. They could use a forward contract to protect themselves from price increases.
That's a great example.
Yeah, and to show how this works visually, Hull uses an example of a currency exchange forward contract.
Okay, so let's say a company here in the U.S. needs to pay a supplier in Europe 1 million euros 3 months from now.
Right.
They could enter into a forward contract with a bank to lock in the exchange rate today.
Yeah, that way they know exactly how much it's going to cost them.
And they avoid all that uncertainty with currency fluctuations.
Exactly. And Hull then shows us the payoff diagrams for both the buyer and the seller of that contract. It shows how their potential gains and losses depend on the future exchange rate.
So if the euro gets stronger...
The buyer of the contract wins, but the seller loses, and vice versa.
Okay, so next up we have futures contracts. They're kind of similar to forward contracts, but there are some key differences, right?
Right. The main difference is that futures contracts are standardized and traded on exchanges.
So they're more liquid.
Yeah, exactly. Much more liquid and transparent than forward contracts, which are usually just between two parties.
And that standardization means they can be bought and sold easily on exchanges, creating a more active and efficient market.
And Hull also explains something called margin requirements.
Oh, yeah. What are those?
Well, in futures trading, exchanges require these deposits to reduce the risk that one party might default on the contract.
So it's like a financial safety net.
Exactly. Make sure everyone can honor their commitments.
Now, finally, we get to options.
Oh, yeah, options, perhaps the most interesting of the derivatives.
And maybe the most complicated.
Well, they can seem complicated, but they're not so bad once you understand the basics. Basically, they give the holder the right, but not the obligation, to buy or sell something at a certain price.
Okay.
That price is called the strike price.
Okay.
And this right can be exercised on or before a certain date.
So you have a choice, but you don't have to do it.
Exactly. You can exercise the option if it's beneficial to you, but if the market moves against you, you can just let it expire.
Okay, so you're not locked in.
Exactly. And Hull goes over different types of options, like call options.
Which give you the right to buy.
Right. And put options, which give you the right to sell.
Okay.
And the value of an option, that's determined by all sorts of things, like the price of the underlying asset, time until expiration, volatility, interest rates. It's a whole big mix.
So lots of moving parts.
Oh, yeah.
Before we move on, let's take a quick detour to a really interesting story that Hull tells. The story of Jerome Kerfeal, the Sogin trader who went rogue and caused this massive loss for his employer back in 2008.
Oh, yeah. Kerfeal, he's a classic example of what can go wrong.
He was making unauthorized trades.
Yeah, he was hiding his activities and it all spiraled out of control.
It's a cautionary tale about speculation and the importance of risk management. Even in these highly regulated environments, human behavior can still be a huge source of risk.
Oh, for sure. No system is perfect.
It shows how important it is to have those checks and balances in place. Okay, now let's shift our focus to another major event that really shaped the financial landscape. The subprime mortgage crisis of 2007.
Oh, yeah, that was a big one.
This crisis led to a global financial meltdown. It really exposed the vulnerabilities of the system and the consequences of poor risk management.
When risk is underestimated, things can go south really quickly.
So Hull dives into the factors that led to this crisis, starting with the government's push for increased homeownership, which led to looser lending standards and this surge in subprime mortgages.
Right. Those mortgages were often given to people with poor credit.
And those subprime mortgages were then bundled into these complex investments called mortgage-backed securities.
which were then sold to investors all over the world.
Yeah, and the book actually shows how these mortgages were transformed into these seemingly attractive investments. But the real risk was hidden.
It was all smoke and mirrors.
So when housing prices started to
Oh,
fall,
boy.
all those subprime mortgages started to default.
Uh,
And that triggered this chain reaction that spread through the entire system.
it was a disaster. Bank failures, massive bailouts, global recession. It was a mess.
It really highlights how interconnected the financial system is
Oh, yeah, for sure.
and how risks in one area can quickly spread.
Absolutely.
Okay, so to wrap up this first part of our deep dive,
Okay.
let's talk about a concept that might seem a little abstract at first.
Yeah.
Risk-neutral valuation.
Okay.
It's a method that's often used in derivatives pricing,
Right.
and it involves this simplifying assumption that all investors are risk-neutral.
Meaning they don't demand any extra return for taking on risk.
Now, that might sound a little counterintuitive,
It does, doesn't it?
but by assuming this, analysts can simplify those complex models
Yeah, it makes the calculations a lot easier.
and focus on the probabilities of different outcomes without having to factor in individual preferences.
Exactly.
And this leads us into the world of options trading and those key Greek letters that all options traders need to know.
Oh, yeah, the Greeks.
Yeah.
They can be a little confusing at first, but they're really just measures of sensitivity.
Okay.
So things like delta, gamma, theta, and vega, they tell you how much an option's price is likely to change based on things like the underlying asset's price, time to expiration, and volatility.
So, for example, delta tells you how much an option's price is expected to change if the underlying asset moves up or down by 1 point.
Right, and gamma measures how much delta itself is likely to change.
It's like a second-order effect.
Exactly.
Okay.
And understanding these Greeks is crucial if you want to manage risk in options trading. They give you insights into how an option's value might fluctuate as the market changes.
They're like tools that can help you analyze potential risks and rewards.
Exactly.
Now let's talk about another important market indicator, the LIBOR-OIS spread.
Okay.
So LIBOR is the London Interbank Offered Rate. It's basically a benchmark interest rate that banks use to lend to each other.
Right.
And OIS is the Overnight Indexed Swap Rate. It reflects what the overnight rate is expected to be over a certain time period.
Okay.
So the spread between these two rates, the LIBOR-OIS spread, that gives you insights into credit risk and how confident banks are in lending to each other,
Right. When there's a lot of financial stress, that spread tends to widen.
like during the 2008 crisis.
Exactly. It's like a warning sign that something might be wrong.
Okay, so now to get into the world of interest rate movements, Hull introduces this statistical technique called Principal Components Analysis.
PCA.
Yeah, PCA.
It's a really powerful tool for understanding what drives those interest rate changes.
Because it's a really complex system.
Oh, yeah. You've got all these different interest rates that are interconnected. And PCA helps you break it down, see what the main drivers are behind those movements.
It's like taking this big, complicated knot and untangling it.
Exactly. And that's really important if you want to manage interest rate risk, especially for those institutions that hold a lot of bonds or other assets that are sensitive to those changes.
Okay, now let's talk about volatility. This is a concept that's often misunderstood.
Yeah, it can be. But
Okay.
it's really just the degree to which an asset's price fluctuates over time.
Okay, so how much it goes up and down?
Exactly. And it's a measure of uncertainty and risk.
So the more volatile something is.
The riskier it is.
Okay, and Hull talks about this index called the VIX.
The fear index.
Yeah, what's that all about?
Well, it measures market expectations of future volatility.
So it's like a gauge of how worried investors are.
Yeah, exactly. When the VIX is high, it usually means there's a lot of fear and uncertainty in the market.
And when it's low?
Things are calmer.
Okay.
So it's a pretty useful tool for understanding market sentiment.
Okay, now to actually model and predict volatility, Hull introduces us to something called ERCH models.
Generalized autoregressive conditional heteroscedasticity.
Yeah, that's a mouthful.
It is. But basically, there's statistical tools that try to capture how volatility tends to cluster in financial markets.
What does that mean, cluster?
Well, it means that periods of high volatility are often followed by more periods of high volatility, and the same goes for low volatility.
Okay.
So JRCH models can help you estimate and forecast volatility, which is really important for managing risk in portfolios that are sensitive to those price swings.
Okay. And lastly, Hull introduces us to copula models.
These are statistical tools that are used to model the relationships between different financial variables.
Okay.
They're especially helpful when those variables might not be well represented by traditional correlation measures. Okay. So he mentions Gaussian copulae, which assume a normal distribution, but he also points out that they're not so good at capturing extreme events, or what we call tail dependence.
Okay, so they might not be the best for those really rare but potentially catastrophic events.
Exactly.
Well, that brings us to the end of part 1 of our deep dive.
Already.
I know, right? We've covered a lot of ground. But don't worry, there's more to come. If you're enjoying this, don't forget to hit that like button and subscribe to our channel for more insightful book summaries.
Yeah, we'll be back with part 2 soon.
Welcome back, everyone. In the last part of our deep dive into John C. Hull's Risk Management and Financial Institutions, we covered a lot of ground. We talked about risk and return, looked at different financial instruments, and even touched on some major historical events that shaped the financial landscape. But buckle up, because in this part, we're going to go even deeper into the world of risk management.
That's right. We're going to be exploring some of the more advanced techniques and tools that are used to manage risk.
Okay, so let's dive right in. One of the most crucial concepts we need to understand is value at risk, or VAR.
Yeah, VAR. It's a pretty common term in risk management.
It sounds kind of technical, but it's actually a pretty intuitive way to think about potential losses.
Yeah, it's basically trying to answer the question, how much money could we potentially lose in a worst-case scenario?
Over a specific time frame, right?
Exactly. And with a certain level of confidence. So, for example, if a bank says its one-day 99% VAR is $10 million, that means they're 99% confident they won't lose more than $10 million in a single day.
Okay, so there's always that 1% chance of a bigger loss, but VAR is focusing on the most likely risks.
Right. It's about managing those risks that you can actually model and quantify.
But it's important to remember that VAR is not a crystal ball. It can't predict everything, especially those really rare events.
Yeah, those black swan events that can really throw things off.
And that's where expected shortfall, or ES, comes in. It goes beyond VAR by looking at the average loss you would experience in that 1% of worst-case scenarios.
So it's kind of like a backup plan for when things really go wrong.
So it gives you a more complete picture of your potential losses, especially during those really extreme market downturns.
Exactly. VAR tells you the maximum likely loss, while ES tells you what to expect if that loss is exceeded.
Okay, so having both VAR and ES would give you a much better understanding of your overall risk.
Absolutely. And they both can be calculated over different time horizons, so you can have like a one-day VAR or a 10-day VAR.
It all depends on what you're trying to measure and how much risk you're willing to take on. Now, the book mentions that these calculations often assume that daily market changes follow a normal distribution, that bell curve.
Right, but that's a really important point. Real-world markets don't always behave so perfectly.
Yeah, they can have those fat tails where
Yeah.
extreme events are more likely than you might expect.
And that means these calculations are estimations, not guarantees. You always have to be aware of their limitations.
Right, you can't just blindly trust the numbers. You have to understand the assumptions that are being made.
Exactly. And that leads us to the concept of model risk.
Oh yeah, model risk.
Yeah.
If I understand it correctly, it's the risk that any model, no matter how sophisticated, can't perfectly capture all the complexities of the real world.
That's a great way to put it. It's like trying to fit a square peg into a round hole. No model is perfect.
So you always have to be aware of the potential for errors and biases.
And that's why it's so important to backtest models, compare them to real-world data, and constantly try to improve them.
Yeah, it's a never-ending process of refinement. Okay, now let's switch gears and talk about the regulatory landscape. Those rules and frameworks that govern the financial industry.
Right, the regulations that are designed to prevent another crisis.
And one of the key players in this area is the Basel Accords.
The Basel Accords are a set of international agreements that are meant to make sure the global financial system is stable. They've been around for a while, and they've evolved over time.
Yeah, we've had Basel First, Basel II, and now Basel III.
And each one builds on the previous one, trying to learn from past mistakes and address new risks that emerge.
So it's a constantly evolving process, trying to keep up with the changes in the financial world.
Exactly. And one of the core principles of Basel is to set these minimum capital requirements for banks.
So basically forcing banks to hold enough capital to cover their potential losses.
Right, it's like a cushion to absorb shocks.
And that helps to prevent those domino effects, where one bank failure can trigger a whole cascade of failures.
Exactly. And the evolution from Basel I to Basel II and Basel III shows you how our understanding of risk has become more sophisticated.
So Basel I'm mainly focused on credit risk, the risk that borrowers might not repay their loans, but Basel II expanded that to include market risk and operational risk.
And Basel III came after the 2008 financial crisis, and it really focused on liquidity risk.
Right, that's the risk that a bank might not be able to meet its short-term obligations, even if it has valuable assets.
It's like having a treasure chest full of gold but being stranded on a desert island. You can't use it.
And Basel III introduced those liquidity ratios, the LCR and the NSFR, to make sure banks have enough liquid assets on hand.
Yeah, it's like having a reserve tank of fuel, so you don't run out completely.
Now let's talk about marking to market. It's a really important concept for understanding a financial institution's health.
Right. Marking to market means valuing assets based on their current market prices.
So it's like taking inventory and seeing what your stuff is worth today, not what you paid for it years ago.
Exactly. And it's really important for transparency and accurate financial reporting.
But what happens when there's no easy way to determine a market price for an asset?
Like a complex derivative or something that doesn't trade very often.
Yeah, exactly.
Well, that's where marking to model comes in.
So instead of using actual market prices, you're using a model to estimate the value.
Right. It's like getting an appraisal for something that's really unique.
But that introduces another layer of complexity, right? Because now you have model risk.
Oh, yeah, that's a big one. If your model is wrong, your valuations could be way off.
So you really have to make sure your models are accurate and that you're validating them properly.
Absolutely. You can't just blindly trust the model. Okay, now let's switch gears again and talk about physical commodities.
Oh yeah, commodities. Things like gold, oil, wheat, and copper. They're different from stocks and bonds, right?
Exactly. Commodities are tangible goods. They're things you can actually touch and hold.
And their prices aren't just determined by supply and demand. There are all sorts of other factors that come into play.
Like storage costs, transportation costs, seasonality, weather patterns, and even geopolitical events.
It seems like a lot to keep track of.
It definitely is. And all of these factors can lead to a lot of price volatility, which can be a real challenge for businesses that rely on these commodities.
Yeah, it can make it really hard to manage your costs and make sure you have the supplies you need.
And then there's the concept of convenience yield.
Convenience yield? What's that?
It's basically the benefit you get from actually holding the commodity. It's like having food in your pantry during a snowstorm. You might not need it right away, but it gives you peace of mind.
So you're willing to pay a premium for that security.
Exactly. And that convenience yield can affect commodity prices.
It's interesting how the physical world and the financial world interact in the commodity markets.
Yeah, it definitely adds another layer of complexity.
Okay, now let's move on to credit risk management. This is all about understanding the risk that borrowers might not repay their debts.
And that's a big concern for any lender, whether it's a small bank or a huge investment firm.
So how do lenders manage that risk?
Well, there are a number of tools and techniques they use. One common one is credit scoring, which is basically assigning a number to a borrower based on how likely they are to repay a loan.
That's like a financial report card.
Exactly. And those scores help lenders decide whether to lend money and what interest rate to charge.
And then there are those credit ratings from agencies like Moody's and Standard & Poor's.
Yeah, those ratings give investors and lenders a standardized way to compare the creditworthiness of different borrowers.
So it's easier to make informed decisions about where to invest your money.
And Hull also talks about these things called ratings transition matrices.
Okay, what are those?
They basically show the probabilities of a company's credit rating changing over a certain period of time.
So, for example, a company with a BBB rating might have a certain chance of being upgraded to A or downgraded to BB or even defaulting completely.
Exactly. And banks can use these matrices to understand how their credit risk might change in the future.
So they can adjust their portfolios accordingly.
And to get even deeper into credit risk measurement, Hull discusses credit metrics. It's a more sophisticated approach that takes those potential rating changes into account.
So it's not just about the probability of default. It's also about how much you could potentially lose if a borrower's credit rating goes down.
Exactly. It uses those transition matrices along with data on credit spreads to estimate the potential range of outcomes for a portfolio of loans or bonds.
It seems like a powerful tool for stress testing a portfolio and seeing how it would perform under different credit scenarios.
It definitely is, and it's just one example of how credit risk modeling has become more sophisticated over time. Now, Hull also talks about Credit Risk Plus, which is a different approach that focuses specifically on defaults.
So it's like zeroing in on the worst case scenario.
Exactly. It uses statistical methods to estimate the probability of default over different time periods.
And that can help lenders who are really concerned about those extreme events.
Now, to show just how important good risk management is, Hull takes us back to 1998 and tells the story of long-term capital management, or LTCM.
Oh yeah, LTCM. They were a hedge fund that was considered one of the smartest on Wall Street.
They had a team of Nobel Prize-winning economists and mathematicians.
But they still blew up.
Yeah, it's a classic example of how even the smartest people can make mistakes, especially when they're overconfident and using too much leverage.
So they had this highly leveraged portfolio that seemed diversified, but then a series of events happened that they didn't anticipate.
And their bets went bad and they lost billions.
It's a reminder that no matter how smart you are, you can't predict everything. And that's why stress testing is so important.
Right. Stress testing is all about trying to imagine those what-if scenarios, those events that could really challenge your assumptions.
You have to think about the things that could go wrong, even if they seem unlikely.
Exactly. And Hull emphasizes that you can't just rely on historical data for stress testing. You have to use your imagination and think about those black swan events.
Now, in addition to the capital requirements that regulators impose, financial institutions also have their own internal capital assessments.
Right. They have to figure out how much capital they need based on their own risk appetite and their own internal models.
And that internal estimate is called economic capital.
And it's basically a way for the institution to double-check the regulatory requirements and make sure they're being even more conservative if they need to be.
So it's like having a second set of eyes on your risk management.
Exactly. And to evaluate the performance of different business units or investment strategies, Hull introduces the concept of ROCE.
ROC.
Yeah, it stands for Risk-Adjusted Return on Capital.
Okay, so it's a way to measure how much profit you're making relative to the risk you're taking.
Exactly. It helps you make sure you're getting rewarded for the risks you're taking.
And that leads us to the idea of enterprise risk management, or ERM.
ERM is a way of managing all the different types of risks that an organization faces, not just financial risks.
So it's like a holistic approach, looking at the big picture.
Exactly. And it emphasizes the importance of having a strong risk culture where everyone in the organization is thinking about risk and taking responsibility for managing it.
It's not just the job of the risk management department. It's everyone's job.
Now, even with the best risk models and the strictest regulations, we can't forget about the human factor.
Yeah, as we saw with that Jerome Carfield case, people can make mistakes, even really smart people.
And Hull talks about all these behavioral biases that can cloud our judgment.
Things like overconfidence, anchoring, confirmation bias, and herding behavior.
And those biases can lead us to take on more risk than we should.
So it's important to be aware of these biases and try to mitigate them.
And that means having good systems and processes in place that can help us make better decisions.
So, as we've seen in this part of our deep dive, risk management is a complex and constantly evolving field.
And it's not just about numbers and models. It's also about people and culture.
And Hull's book does a great job of laying out the key concepts and tools that are needed to navigate this world.
It's definitely a valuable resource for anyone who wants to understand risk and make better decisions.
Welcome back to the final part of our deep dive into John C. Hull's Risk Management and Financial Institutions.
We've covered so much already, it's hard to believe we're already at the end.
I know, right? From risk and return all the way to credit risk models and those historical events like the subprime mortgage crisis.
But we're not done yet.
Not quite.
There's still so much to explore.
Exactly. Today we're going to be talking about the evolving regulatory landscape and some of those challenges and opportunities that lie ahead for risk management.
It's a fascinating area, because regulators are always trying to catch up to innovation and, those new risks that pop up in the financial system.
Yeah, and one thing that's come up again and again is just how interconnected everything is in the financial world.
Oh, yeah, for sure. What happens in one corner of the market can quickly affect everything else. We saw that in 2008.
And that's why regulators are so focused on systemic risk these days.
Right. The risk that if one institution fails, it could trigger a domino effect.
And potentially bring down the whole system.
Exactly. So it's not just about protecting individual banks or investors. It's about making sure the entire system stays stable.
So one of the key reforms that Hull talks about is the use of those stress tests.
Oh, yeah. Those are important.
They're designed to see how banks would handle those extreme but, plausible economic scenarios.
Yeah, it's like putting them through a financial pressure test, simulate some really tough conditions and see if they have enough capital to survive.
And those stress tests aren't just hypothetical. They actually have consequences for banks.
Oh, yeah. They can influence things like capital planning, dividend policies, even lending decisions.
So they're a really powerful tool for regulators to use.
Definitely. They can help identify potential problems before they become major crises.
Hull also talks about that concept of too big to fail. The idea that some institutions are so large and interconnected that if they were to fail, it would be catastrophic.
Right.
And that's a real challenge for a regulator.
It is. Because on the one hand, you don't want any institution to be so dominant that its failure could bring down the whole system.
But you also don't want to stifle competition or create this situation where institutions think they'll always get bailed out.
Right, that moral hazard problem.
So it's this balancing act,
Yeah.
trying to encourage innovation and competition, but also making sure the system stays stable.
It's tricky, for sure.
So this whole debate about too big to fail has led to a bunch of reforms.
Oh, yeah, things like higher capital requirements for those systemically important institutions, more supervision, even creating ways to wind down those failing institutions without causing panic.
Yet nobody wants another Lehman moment.
Definitely not.
And this focus on systemic risk has made financial regulation a lot more complex.
Oh, yeah, way more complex.
And Hull talks about how challenging it can be to navigate this, especially for those institutions that operate all over the world.
It's a lot to keep up with, all those different rules and requirements in different countries.
It's like a compliance nightmare.
It is.
Yeah.
And it's created a huge demand for people with risk management skills. You need people who can understand the models, but also all those regulations.
It's a very specialized field for sure.
Yeah, you need a mix of skills. Quantitative, legal, and business.
Now, besides those external regulations, institutions also have their own internal risk management frameworks.
Right, they have to decide how much risk they're willing to take on.
So it's about aligning those internal frameworks with the external rules.
Right, you have to satisfy both your own stakeholders and the regulators.
So it's this two-pronged approach.
It is, and it means you need a really good understanding of your business model, the regulations, and how to translate all that legal stuff into practical risk management practices.
As we finish up our exploration of Hull's book,
Yeah.
one of the big takeaways for me is that risk management is not just about numbers and formulas.
Oh, no, it's about people, too.
It's about creating the right culture.
A culture of awareness, accountability, where everyone understands their role in managing risk.
And that means being transparent, communicating openly, and being willing to learn from mistakes.
It's the only way to build a truly resilient organization, one that can adapt to whatever challenges come up.
I think that's a great point to end on.
Yeah.
Hull's book has given us such a thorough look at risk management.
Oh, yeah. It's been a great journey.
It really has.
Yeah.
From those fundamental ideas to the really advanced stuff and the whole regulatory landscape, it's an essential resource for anyone who wants to understand risk better. Whether you're an investor, a risk manager, or just someone who wants to navigate the financial world with more confidence.
Absolutely.
So thank you for joining us on this deep dive, and we hope you found it insightful. Remember, risk is always out there, but by understanding it and using the right tools, we can create a more stable and resilient financial system for everyone.